quote Warren Buffett a little too much for my wife's taste, but the perfect time holding period is forever. I imagine Berkshire and Markel's decline could be a lot less just because they could start buying their own stock back.
A unique aspect of companies like Berkshire Hathaway and Markel is the creation of almost a cult-like, in a good way, shareholder base, a loyal base of long-term shareholders who will hold through thick and through thin. This is not accidental. Both of these companies invest significant resources, time, money, mental energy in creating this base, this tribe of long-term, high-quality investors that they believe helps them economically in the sense of a less volatile stock price, just in a more loyal holding. So my guest today is Martin Wiegand, and he is in many ways the perfect picture of one of these long-term shareholders. He owns Berkshire Hathaway. He owns Markel Holdings. He owns Graham Holdings. This is a smaller value-focused fund in the holding company, I should say, in the Washington, D.C. area, famous for previously owning the Washington Post. And I'd like to unpack with Martin today, not just the power of a long-term, high-quality shareholder base, but also the psychology. What appeals to him? What would make him sell these companies also if he had to? So, Martin, we met last year at Berkshire or on the plane to or from Berkshire. Thank you so much for joining me.
Well, thank you for having me. Yes, I think we met on the plane going out, and then we sat together on the plane going back too.
It's amazing how many of the same faces you see at Berkshire and at Markel, and I know you do Graham Holdings. I don't go to those yet. Although the CEO was speaking today to Tom Gayner, the CEO of Markel. So it is quite a small and incestuous, in a good way, world in this value investing community.
It is. It is.
So for the audience, what is the 30-second tender profile, if you will, your investor profile? I know you've got a loving wife, so I don't mean a real social media profile, but you unfortunately were not able to make it down to Richmond here for family reasons. But can you just give the audience a little bit about you for background?
Well, I've been a Berkshire shareholder for a long time. My father was a Berkshire shareholder for a long time, and I actually met Tom Gayner standing in line going into the Berkshire Hathaway meeting 20 years ago or more, maybe.
Wow.
And we started chatting. A friend I was with, a guy named Charlie Frischer, introduced me to Tom Gayner, and Tom had a couple other people with him. We started chatting. It's a cold, rainy morning in Omaha at 5:30 as we're sitting around. There's not a whole lot to do, and just started talking to Tom, and he was engaging and smart and forthright and honest, and we hit it off right off the bat. So it didn't take a long stretch to become a Markel shareholder right after that.
So you've been going literally decades. You've been a shareholder of Berkshire, and it sounds like for Markel quite a while as well. Let me ask you the difficult question: what would it take to make you sell these companies?
Well, it's certainly not anything I'm looking to do. I quote Warren Buffett a little too much for my wife's taste, but the perfect time, holding period is forever.
Yep.
So it's not on the horizon. I'm not going to sell them to buy another stock. If there was some great life change or something, I could sell something, but it's not going to be because I figure out that, gee, this is a great stock. I think I should buy some of that. So I'll forego any great future for the comfort level that I have owning Berkshire and Markel and Graham.
So you are exactly the shareholder they want. In other words, someone who's really in it for the long haul, and unless he gets sued for a bazillion dollars and needs some cash, he's going to hold.
Yeah. I don't sit there and watch the stock price or anything like that. I want to buy something, hold it for 20 plus years and forget about it. Berkshire, Markel, I'm not so much Graham, but they have a long runway to continue to compound for a lot of years. I don't expect they're going to be compounding like Google and Amazon or Apple or anything like that. But I think they have a very good potential to compound better than the S&P over the long haul. So I'm very happy just to own those and forget them. I trust Warren Buffett. I trust Tom Gayner. I trust Don Graham and Tim O'Shaughnessy completely. So I have no qualms about holding on to their stocks.
And I don't want to ask about the S&P in a second, the performance in a second, but just backing up, one thing you said I want to double click on, which is, or I guess everything you said fits in the rubric of the old style of investing. What I mean, old style means before we had like minute to minute stock trading. There were just private companies. You could argue that the securitization of companies has been one of the best things for mankind in the sense of just enabling more cash to flow into companies, but it's also been deleterious in a certain way to the extent that it kind of warped the perspective of what a company is. It was no longer a company, it was some blip, right? It was some ticker. It was something that went up and down many times during the day. And I tend to think on a societal level, that's kind of unhealthy because people kind of miss the point of what a good company is. You want to find good companies. You want to avoid bad companies. And doing that is healthy for the economy. Whereas if you're just day trading, if you're trading because of some chart pattern, because something's going to, has momentum, going to be up in a month or whatever, you're probably injecting noise into the market. And all else equal, volatility is a valuation reducer. So I could argue that those stable long-term folks are healthier. It's not just better for their own personal finances. It's not just better for the companies. It's actually better for the whole economy as well. Would you agree with that?
I totally agree with that. There's always, I think Tom Gayner even pointed out in one of his slides many years ago about the average investor who trades a lot. And even though the market is going up, because they buy when things are high and sell when things are low, their average return has been lower than the market, even though if they just held on, they would have done fine.
Yeah, it's shocking, right? Dalbar Research found that over, I think, 20-year or 30-year period, like when the S&P did 10.4% annually, the average mutual fund investor in the U.S. got 4.4%, something like that. It's crazy.
So, it is sort of crazy, but I suspect the research is true. And I'm a small businessman. I'm totally focused in business hours on my business. I don't have time to sit here and watch the stock prices of the companies that in which I invest. And I'm very happy to let Warren Buffett and Tom Gayner and Don Graham manage their companies, and I don't have to worry about it.
So speaking of stock prices, Martin, though, I got to ask you this question. I looked, Berkshire Hathaway has grown something like 3.8 million% through its whole life. And it would be even higher if you included the Buffett partnership prior to Berkshire Hathaway starting in the 1960s. So pretty amazing. 19.8% per year compounded. Over Markel's 38-year publicly traded life, 15% compounded, which is still pretty darn good. It's better than the market in general. However, over the last 10 years, Markel has underperformed not just Berkshire, but the S&P. Same thing over the last 5. It did better over the last 3 years, not as good over the last 1 year. It's doing better than both of them year to date. So in other words, in recent year, its long-term history is great, but its recent year history is kind of mixed. Does that bother you, or it sounds like it doesn't?
It doesn't. So I remember a shareholder asked Warren Buffett a question back in the dot-com era, when the dot-coms were taken off and Berkshire was a little flat or whatever. And one shareholder stood up and said, "Can't you give us just a little bit of the dot-com?" And Warren just put his head down and just said, "It's not my game. I don't do that." So I'm perfectly happy in letting the the S&P beat them for a while. There's also the comfort in owning a stock, particularly Berkshire, that's got so much cash. It's like an index fund nowadays, but with a big pile of cash, so that there's a floor there. The S&P could have a pretty big decline. I imagine Berkshire and Markel's decline could be a lot less, just because they could start buying their own stock back and keep themselves good. But again, if the stock price goes down, I'm a fortunate person, and I don't need that to live or anything. And I'm perfectly happy knowing that if the stock price does decline, Berkshire and Markel will have some opportunities to buy stuff cheap that they could hold on to for better times and be better in the long run.
Tom Gayner believes Markel is underpriced, and if you look at a graph of Markel's share repurchases, it's gone up, 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 up. So he is putting the company's money where his mouth is. Yeah.
Yeah.
One or two final questions. So one could argue that one of the reasons Markel has underperformed Berkshire is simply the valuation multiple the market assigns to the company. Berkshire trades at a PE ratio of 12 point something. Markel trades at a PE ratio of 8 point something. So Berkshire, in other words, is like almost 50% more highly valued, even though the businesses themselves are like pretty similar. You know, insurance companies in one respect, private companies, some public companies run by good stock pickers. Do you think, this is just speculation, but do you think that will ever change? Like Berkshire's star might dim a bit, Markel's might brighten a bit, or will it always be that way?
Well, I suspect so. I don't know how bright Markel's star is going to shine eventually, but obviously one day Warren Buffett's going to pass away, and we saw it when Charlie passed away, and I think Warren is quoted as saying, "Well, I kind of hope that the stock does go down a little bit when I die. I'd feel terrible if it didn't, just drop a little."
Yeah, you want your friends to miss you, kind of, right? Yeah,
well, exactly. Warren Buffett is a charismatic person, unlike anybody in American business since I don't know who. So there is I'm sure there's a multiple premium that investors pay to buy Berkshire.
Yeah.
I suspect that will back off a little bit, but I think Berkshire's moats are very strong, and I think their competitive advantage is durable. So I'm happy hanging on.
So last question, Martin, if you were hired as like the 30-second pitch man for either Berkshire or Markel for the annual meeting, and you were speaking to some people who were like kind of interested in the meeting, they're kind of on the fence, but they're not like quite sold yet on going to their first meeting, like how would you persuade them to go?
Well, it's funny you ask that, because I do bring people to the Berkshire Hathaway meeting with me, both of my sons, this year my two brother-in-laws, a friend, and I try not to bring too many in one year, but over the years, I've brought 5 or 6 friends, and it's always a low-key pitch. I always tell people what a great time and finally they come around and say, "I'd really love to do that one year." And I'm like, "Well, you better hurry up because they're not getting any younger, so you better come." And they do come. And to a person, my brother-in-law, first meeting this year, he was blown away. He couldn't believe how many people came, how long Warren Buffett spoke to everybody, how the breadth of his knowledge is amazing. And then just walking around and seeing all the other people and meeting all these other people is pretty impressive. There's nothing else like it. I guess Markel's sort of like it, but other than those two, that's about it that I know of.
Yeah, they're really two of a kind. Markel is, maybe a little less than 10% of the Berkshire meeting, but it's the same thing in baby form, the same principles at least. And I've never seen you alone, obviously, at the meeting. So you are certainly doing a good job as the de facto pitch man for Berkshire. And I'm guessing for Markel as well, and somewhere in the cosmos, not just Charlie Munger out there, but Warren Buffett and Tom Gayner would be very happy to hear really everything you said today, because, like I said, you are really the quintessential long-term quality shareholder. Not just those companies, but really any company would want to have. They'd want to have a Martin Wiegand on their side. And I think, like I said, it's not just good for you, Martin, but it's good for humanity. So thank you for doing what you do
right now. But I'm glad that that Warren and Tom would be happy.
Yep. I'm sure they would be. So, Martin, thank you so much for joining us. It was a pleasure. You've been generous with your time, I should say. And thanks to you guys, as always, for watching us at home.